All right, we'll take this here. We're in a low volatility environment, okay? And Ken, I'll show you where I look for that when we get to your other question too. So just running a search here for bull put credit spreads. Well, I see we've got some small net credits, 22 cents, but it's a 28% return because it's a $1 spread. Okay, the market, we have a low volatility. Let's say I just want to look for bull put credit spreads on decent stocks that are maybe 20 to 35 days out in time. I want at least a 50 to 60 cent net credit minimum, and I want to make sure I'm getting at least a 10% yield and a good probability. Well, if they're there, this tool is going to find them. So let's put in all months for our expiration time frame. I'm going to put in, what did I say? I'm sorry. Let's put in 20 to 45 days for now. So we'll see some of the 2-week out, 3-week out weeklies and so forth. My net credit, minimum of 60 cents. Not going to worry about out of the money because I'm still going to want to look for a high probability spread. So I'm going to put in a probability of at least 75. Oh, I skipped over return, didn't I? I'm sorry. There we go, percent return. Want to be at least a 10% leveraged yield with a 60-cent net credit. Probability at 75% or higher. I'm going to want to see some basic option volume and open interest. So I'm going to put in a option volume today of at least 10 contracts and open interest of at least 100. And to keep things simple, I'm only going to look for 5-point spreads. Okay, so I'm going to set my strike difference to be equal to 5 points. To make sure that I'm still looking for decent things, I'm going to only look for stocks that have shown earnings, at least 5% earnings for last year, this year. PE ratio, let's keep that relative 0 to 50. This is a common criteria I use for my bullish positions. Market cap, I'm going to put this greater at 2,000, so I'm only looking at mid to large cap stocks. I want to avoid anything that might have an earnings between now and expiration. And then the technicals, I'm just going to want to see a stock that's trading in an uptrend. So let's just select stock to be above SMA 50. Not a lot of criteria, but I am looking still for good credit. I need a good minimum return of at least 5%. Did I not put that in? Oh, I'm sorry, 10%. Sorry, folks, greater than 10%. Okay, and let's run this search. Okay, so we didn't see anything that matched our criteria. At this point, I may have to go further out in time. Let's go out to 55 days. And let's narrow this down to 10. Let's open our search range a little bit. Okay. Well, there's one. It's Baidu. It's probably a little bit more volatile, but that's why we're getting the 5-point difference that we want, minimum net credit that we want, and the 14.2% yield. Okay. So if there are positions out there that match the return you want and the stocks that you want, this tool is going to find them. Okay. So volatility is a double-edged sword. And one thing that's good for a market with low volatility, if you're not seeing a lot of movement, well, you'd think that maybe Iron Condors or short strangles, not something I trade, but Iron Condors or short strangles might be a good position. And you're right. But what you have to remember is that you're not going to be able to maybe find as high as the credit or as high as the percent return you want with a low volatility market. But there's still good strategies to trade. Okay, so over the years, Ken, I've just learned that, yes, I do switch from time to time from different strategies, bullish or bearish, or sometimes credit spreads. Market conditions, I might go to calendar spreads. I may do more Iron Condors in my portfolio depending on the market conditions. But the concept is still the same. Okay, if you're an income trader, you're still going to be focusing on the spreads, Iron Condors, maybe doing naked puts or covered calls even, calendar spreads, for example. You're not going to see the same return you might have 6 years ago or 5 years ago, but they're still good positions to trade based on your investing goal. That's the first thing you have to make sure that you set up, Ken, is you have to make sure that you have a trading plan and an investing plan in mind. Okay? All right. Now, let's jump to Leo's question, which also relates to Eric's question. And Eric's question from earlier, let me see, what was the exact phrasing of Eric's question that he had sent previously? There we go. Eric's question was, what trades can I make monthly that can make regular income? Leo's question is, any strategy that is consistent in earning income? Well, here's the trade-off, folks, and I'm sure you've heard us all say this before, but as options traders, we know this up front. If I was talking about income strategies, what am I talking about? Income on a monthly basis. Let's go to the other strategies tab. For regular income, I may look at something such as collars, bear call credit, covered call, naked put, calendar call, calendar put, bull put credit, or Iron Condor. Okay. Now, let me just add Iron Condor. Other things, covered combinations, I'm not a fan of those. That's where you do a covered call, but you also sell an out-of-the-money naked put to enhance your premium, but you're also doubling your margin requirement into the position because you have to have money on hold to cover the naked put because the stock ownership doesn't handle that. Short straddles and short strangles maybe as well, but there's short strangles are probably better. Personally, the short strangle doesn't match my risk-reward tolerance because it has unlimited risk to the downside and the upside if the stock really moves against you. I prefer to do an Iron Condor, so I know I have limited risk on those. Okay. All right. So let me just save that configuration. Now, any of these strategies that we're talking about here can generate consistent monthly income. But what's the problem? Well, the problem is if you pick the wrong stock, you're going to have to roll those positions. You're going to have to manage to adjust those as well. And that's the trade-off, is that there's no way that I can say that there's one strategy that's able to consistently generate monthly income that's better than another strategy that generates monthly income. That's the problem, okay? And the reason for that is that you're going to be wrong. And the structure of the trades, such as credit spreads, when I look for a good probability credit spread, a 5-to-1 risk-reward ratio, we saw that one we were making 62 cents on Baidu with a 5-point risk. Well, we're looking at a 9-to-1 to 10-to-1 risk-reward ratio. That's just the nature of the game. So if one trade goes against you, you've wiped out the profit from 10 previous trades. Okay, and covered calls is, I can have positions where I can be rolling calls or selling calls and earning income 3% per month, but at the same time, if my stocks, 2 or 3 of my stocks in my portfolio are dropping 10, 15% per month, I'm generating premium on a monthly basis, but you know what? My account's still down because of the decline. The most common answer to this question, if you ask most investors, what we feel, I don't want to say strongly about, but what we feel is probably the most consistent in normal markets, but you can have different market conditions, is the Iron Condor position, generate income on both sides of the spreads, but we highly recommend that if you're doing Iron Condors as a major part of your portfolio, you should essentially be looking at just doing the Iron Condors on indexes and ETFs because they're not subjected to the wild surprises of an early earnings warning announcement, boardroom scandal, pending patent lawsuit, things of that nature. So with the Iron Condor position, of course, let's go back to the main Iron Condor homepage. What we're doing is looking for a position where we have a wide spread here. Here's our bull put credit spread, and here's our bear call. We want to have a wide enough position where we're probably in the range of screening for positions that have an 80 or an 85% probability between, but we're still generating income that's maybe giving us $1 on a 10-point spread or 50 cents on a 5-point spread because, well, unfortunately, if you're looking for positions that have an 80% probability, you're in that 10-to-1 or 9-to-1 risk-reward ratio. Okay, so without having the time to be able to do an hour or so of back testing on different strategies so you show you which one's the most consistent over the last 8 months, well, let's be honest, the way the market's been, if you're trading covered calls, if you're trading naked puts, if you're doing bull put credit spreads, standard collar positions, you probably saw good returns. You probably had 1 or 2 significant losses over that time on your underlying security or the bull puts going against you, but you probably had close to, I'd say, a 70, 75%, maybe 80% success rate on those positions. And that would give you a reasonable return. But then the management factor that comes into play, that's really what the PowerOptions portfolio tool is all about. It's not just finding the position and hoping everything expires worthless or hoping everything gets assigned. You're still going to have to apply management to maximize your return and minimize your losses in several cases in your portfolio over the 12-month period. So depending on market direction, the bull puts would have been a good one. Iron Condors, but we've seen a lot of Iron Condors and bear call credit spread investors get hurt, where the stock has moved above their short call and they had to roll it. So, just over the past 12 months, I'd probably say that bull put credits, calendar calls, and yeah, even covered calls and maybe standard collars would have been good for generating monthly income and not suffering too many losses, okay? But at the same time, I can't tell you what the market's going to be 3 months from now. I can't tell you what the market's going to be 6 months from now. And for that reason, that's why most investors tend to look for the Iron Condors with the wide range of profitability, looking for the high probability. But again, everything works hand in hand, right? We are in a point of low volatility, so a lot of the iron condors, you may be looking for that 9-to-1 or 10-to-1 risk-reward ratio. So let's say that I have a 10-point spread. I want to receive $1, so I'm risking $9 essentially on that trade if it goes against me on one side or the other to make $1. So it's an 11.1% return. You probably have an 85% probability. This also dictates that you have to be right 90% of the time in order to profit long term. Okay. Again, I've traded covered calls. When I first started trading 11 years ago, I traded covered calls for about 18 months. I moved into naked puts for a while, did okay with those, but now the premium is also really low on the put premiums because of volatility and other factors in the market. Standard collars, I started trading about 9 to 10 years ago, and I still trade them with a portion of my account. I did credit spreads for a while, but honestly, I didn't have enough time to devote to it during the week. Okay. And when hosting webinars, answering phone calls, doing coaching sessions, I was unable to watch the credit spreads closely. There were a lot of times where I was looking at a spread, 2 or 3 days to expiration that looked good. I'd go on a webinar, I'd come out of the webinar an hour later, and the spread's at full loss. Drop below both strike prices or above both strike prices. So that's going to wipe out 10 previous trades. I didn't have enough time to watch it based on what I do. Okay, and so that's the key there with those strategies. So for the past 5 years, what's worked for me, and it doesn't work for everyone, is at any given time 50 to 60% of my account is involved in the radioactive trades. I leave another 20 or 30% of my active trading account in standard collar positions or a combination of collars and calendar spreads, and then about 10% of my portfolio, 10 to 15% of my portfolio, depending on market conditions, I'm looking at credit spreads or perhaps iron condors on the broad-based ETFs and indexes. For me, that's worked the best based on my schedule, the time I can allot to investing in order to do that, to make consistent profits. I'm averaging about 12% per year now. I was not able to do that with covered calls on a consistent basis. I was not able to do it with naked puts. I was not able to do it with the credit spreads because I didn't have the time to devote to trading to watch the market on a consistent basis. Sounds funny because I'm here all day with PowerOptions Open, but I'm usually logged into a customer's account when I'm walking them through the portfolio or how to make adjustments or how to create a search and things of that nature. Okay, so that's kind of the issue there. All right. That spreads take close management. And it's, as Rick said, yeah, that's the main problem with credit and debit spreads and condors. The traders often have one bad trade and it wipes out many, if not all, the previous months. And that's exactly right. Going backwards now, Rick just asked a quick one for the radioactive strategy, married put strategy. What are the best volatility conditions? Well, I was getting going to this at one point, and I kind of got derailed here. Volatility, we're going to have a special presentation on this in 2 weeks or so. We're going to start doing, not next week, but the following week, we're going to start doing presentations on Monday at 4:30, just a half-hour presentation. The first one's going to be on the Greeks, but the second one's likely going to be volatility, the double-edged sword. Why is volatility a double-edged sword? Well, we're in a low volatility market right now, as it was mentioned to us by Ken, and everyone knows that. We're at low volatility. So you think these premium generations aren't going to work that well. Well, that's incorrect. I mean, the market has still been bullish, so we're still going to find successful bull puts, calendar calls, I should say, covered calls, naked puts, collar spreads, married puts worked extremely well in this market. I have several radioactive trades that I've been in for 3 to 4 months that are up over 20 to 30% since I got in. I missed the boat on URI, United Rentals. It's something we opened up in a webinar. I just looked at it today. We were doing an educational webinar, and we looked at the stock, and I was going to open it as a married put when it was at around $65 per share. It's now up to $118. So those would have been perfect. Okay, so low volatility. If we're in a low volatility market and you're still bullish, and who knows what's going to happen in the next 2 or 3 months, right? But low volatility and bullish, well, married puts are going to be a perfect position, not for maybe doing the income methods per se, but for just long-term growth with a protected position. Long calls, calendar spreads, okay? Things that involve buying an option, because with low volatility, we're probably paying into a lower premium, and with a calendar call, we might be able to hedge some of that with a monthly or weekly premium against it, okay? Same with the collar. Of course, we're buying stock, but we're protecting it with a put and selling an at or out-of-the-money call, still be able to get 2 to 3% return and have protection in place. That's why it's one of my favorite strategies. As well. So low volatility market, you think that, okay, well, we want to buy positions, and that's right. But what happens in a low volatility market? Well, there's not a lot of fear, and there's not a lot of stocks that are moving in general. There might be a gradual uptrend like we've seen, but in general, low volatility means no movement, which you don't want if you're buying calls or you're buying married put positions. High volatility, great. We can generate a lot of premium. Okay, we got a high volatility here. We can generate a lot of premium. We can look at things such as, well, collars is obviously the best. I'm going to get to that in a moment. But we can look at things like a naked put or a covered call as the same risk-reward profile. We're going to generate a lot of premium. We might be able to make 3 to 4% per month, where last 2 months ago we were only looking at 1 or 2% for at-the-money positions. This is fantastic. Calendar spreads, again, we might be getting more for selling that near-term call. Bull put credits, a lot of premium here because we're hoping the stock goes up, and we're getting a lot of premium for our spread or even a bear call. And then, of course, we're just looking at Iron Condor, getting more bang for a buck in a high volatility market. Well, the problem with all those profit and loss charts I showed you is that you don't want a lot of movement with those strategies. Bull put credit, you want the stock to be stable or moving up. Bear call credit, you want the stock to be, hold where it is or move down. You don't want it to move up against you. You don't want wild spikes. And covered calls, you don't want to see wild spikes. Sure, it could be a wild spike in your direction. That would work out well, but if it goes in the other direction, you're going to lose more on the stock than you're going to be able to manage with adjusting and rolling down the position. Same with the naked put. Anytime I'm asked the question, now that I've gone through that full circle and did a little bit about the volatility, okay? Rick, yes. Well, Rick says the Mary puts radioactive trading work fine in any volatility environment. I feel that they have. I've been trading them for 6 years, and we've crossed subtle different volatility markets over that 6-year time period. And again, my average annual return is around 11 to 12%, and I'm completely happy with that. But backstory, new investor coming in or someone who's new to options comes in and says, what is the best way to generate consistent monthly income? My answer to you directly is going to be the standard collar. I'm not going to say the bull put credit spread. Let me click on that. See this risk-reward profile? Looks exactly the same as that standard collar, doesn't it? Okay, but this is leveraged. And as Rick mentioned, and as we discussed before, to look for a good bull put that has a high probability of expiring worthless, you're looking at a 10-to-1 risk-reward ratio. You're looking to make $1 to risk 10. Okay, so standard collar is probably, if you're focused on generating income on a monthly basis, looking for maybe a 1.5 to maybe 2.5 to 3% return per month, but you don't want to take the risk of a covered call because you've been burned by those before, and the structure of that trade, does allow for a lot of losses to occur. The standard collar is probably your best bet. I've got to be honest with you. And a standard collar, what we'll look at here, we'll go to my basic search that we created here. And what we're looking at is to buy stock, and we're going to sell an at or just slightly in or an at-the-money call. And this is a conversion. That's not what I want. Let's go here. Let's go to initial values. Okay, so for standard collars. All right, so here's a better one. Lululemon at $39.14. May choose to sell the September 40 call for $1.36 and buy the September 37.5 for $1. When you say, oh, you're only generating 36 cents of premium, and you got to buy the stock to do it, so it's capital intensive, but here's the trade-off. Okay, it has the same risk-reward profile as a bull call debit or a bull put credit, but there's no risk of that leverage hurting you. If the stock plummets to $1 per share, the most you're going to lose is 3.3%, and honestly, that's not going to happen. It could drop below 37.5, and you could take that 3.3% loss, but if you're looking for a bullish stock and it goes up and goes above 40, you'll still make 3.1%, and you've got about a 0.9% or 1% if unchanged. Okay, so honestly, the best way I can answer this question, everyone wants to hear the Holy Grail. I know that. Everyone wants to hear, Mike, tell me that I can only put $5 or $10 of leverage into a position, so I'm not using a whole bunch of my capital, and I'm going to be able to make 3% consistently on a monthly basis, but if I'm wrong on 2 or 3 of my trades, I'm only going to lose 2% or 3%. If I had it, I'd show it to you. So to be honest with you, this is the closest one. I'm sorry, I'm zoomed in, so it's giving a weird graph there. Let me go back to this here and refresh the page. Sorry about that. Perfect, a little bit better. Okay, so there's my current stock price. Yeah, it has a way to move to go up to 40, but even if the stock stays right where it is now, moves a little bit up or a little bit down, we're still generated some premium in, and we've still got 0.1 or 0.5% gain on the position if it's unchanged. And if the stock collapses, if we're completely wrong, we're only losing 3% of what we invested into it. A bull put credit spread might have the same monetary value. Let's take a look. I want you guys to jot this down. Our collar on Lulu, by selling the September 40 call, buying the 37.5 put, same expiration date, max return is 122, and the max risk is 128. Okay, so, and this is for which expiration? The September 20th expiration, standard expiration. All right, let's go up. Now let's compare that to something else. Let's go into View Options. Let's go to September 20th, and we're going to sell the 40 put and buy the 37.5. There's a 40 put we're going to sell. We'll just do one contract, keep the math simple here, and buy that. This is going to be our bull put credit spread. Does have a similar risk reward profile. In this case, based on the natural bid and natural ask, our max risk now is higher. Not a lot, but I mean it is higher. It's 128 versus 137. Okay, so I think we were at 128, and then the max profit on the collar is 122, and here it's 113. But it's an 82.5% return because it's a leveraged trade. Now what's ironic is that when I'm doing a standard collar, I'm invested in the stock. If it doesn't do what I want in the first month, I'm going to continue to rebracket the collar. Whereas a bull put credit spread, I would never sell this as a bull put credit spread. I know you guys wouldn't either. Why? Because you're going to look for a bull put credit spread that has a higher probability of expiring worthless, which means you're likely going to be selling the 37.5 put and buying the 35. So you're going to have a risk reward profile that's more along the lines of, well, that. Terrible drawing. Okay, so you're going to have a much lower net credit. Let's talk about maybe 50 cents or 40 cents or so. You're going to have a risk of $2.10 to $2. So it's a 4-to-1 or 5-to-1 risk reward ratio doing it in that case. Okay, so is this, you know, I pointed this out because the standard collar, we're looking for bullish positions, sure, but in general I wouldn't do this as a bull put. I'd have to use a different one, and that puts us in that different leverage game. So for me personally, if you're focused on generating income on a monthly or weekly basis, you want closer to that 1-to-1 risk-reward ratio, the only way to do it is with a standard collar. I think honestly, that's my opinion. That's what's worked for me, but I'll tell you this. Even with that risk-reward profile I just showed you on the original one, where we were looking to make 3.1% if we got assigned, or 0.1% if unchanged, I'm sorry, 0.9% if unchanged, and we're risking 3.3%. In general, my collars, I'm looking to make about 2.5% to 3% if I'm assigned, with risking 4 or 5%. I still need to be right 60% of the time in order to make profit long term. Okay, even though I have protection in place, I still need to be right about 65, 64% of the time to be right. I've been fortunate that over the years with my collar portfolio, I've been right about 72% of the time. So it's been consistent profit. But again, it's, to me, the reason why I'm using more of my portfolio into the radioactive trades is because that's more consistently profitable, even if I'm not generating income on a monthly or weekly basis. Okay, I'm still matching my goals better than I would with a standard collar that has a capped gain, a covered call, a bull put spread, and so forth. That's just what's worked for me. This goes back to, I know there's a lot of questions that are there, guys, and I'm trying to get to them all here, and I'm bouncing around, and I apologize, but this relates to another question I just saw about 2 minutes ago. It was a gentleman who had asked, can you make weekly income with radioactive trading? Well, it's not designed to do that. You don't force an income method because you can put yourself in a worse position. Let me give you an example. Let's go to the open trades for Fusion. I'm going to go to the Avis portfolio, the Avis position here. This might give us a good enough view. This position's bulletproof. I can't lose on this position. Even if the stock dropped to $1 per share tomorrow, I'm still guaranteed to make 5.5%. This position was opened on 3/6. And the first adjustment I did was on April 21st. Okay, why? Because I wanted to give the stock time to move before I looked to apply an income method following the rules in the blueprint. But when I did the income method, it only looks like we generated a small amount, but after the position worked out as we wanted to, this particular income method, we took our risk from 6.7% down to about 2.7%, so it's a 4% increase over a 2-month period. That matches my goals. That's like generating 2% per month in income to me, because that's exactly what I did. We took in the spread for income method number 5. We took in a premium up front, but when it was closed, After 2 months, we've reduced our risk by 4%. I generated 4% of income. But I didn't do anything in the first month. I didn't do anything in the first week. I waited till it was the right time, applied an adjustment, worked out as I wanted to, very well matched my goals. Okay, as I mentioned, with my radioactive trades, I'm averaging about 12% per year. That's what I'm shooting for. It's about 1 to 1.5% per month, which to me is realistic with most option strategies. You can say that, you can find, you and I could run a search right now and find covered calls that offer 4% return if assigned. They're slightly in the money and more volatile. I guarantee you after trading that at 12 months, I'd be lucky to average 1% a month because a lot of those are going to go against me. And sure, a lot of them I might get assigned and make 4%, but the loss I'm going to take on the stock is probably going to balance it out on those more volatile positions. Okay, and then what do? A month later, or actually no, a couple of weeks later, we do another adjustment and we actually put money into the position, but now we bulletproof it. So on 5/19, we opened it on 3/6, 2.5 months later, we've essentially generated 8.7% in premium. We took it from a 6.7% risk, paid that all the way down to -2% to bulletproof status. So 8.7% in about a 3-month period. It's well within my goals. And this is not the final return. We're bulletproof on this position, 5.5%, but I could close it right now for about a 13% gain, and in 12 days we'll probably make closer to 14%. Okay, so that's 6 months, 14%. A little bit more than 2% per month, well within my goals. Okay, so the relationship of using radioactive trading to try to force an income method to go week by week by week, I think a lot of times I found you're better off following the rules, waiting till it makes sense to apply one of those adjustments. And okay, so I didn't do anything in the first month. Big deal. By the end of the 3rd month, we generated over 4% in premium, which averages out to 2% per month. Probably better than I could have done by trying to sell a weekly call and then have to buy it back because the stock moved up and sell another week, then have to buy it back. Then, oh, let me go further out of the money and sell one for 10 cents. Well, that one expired, but it expired for 10 cents. I'm not really getting ahead with that, forcing adjustments on positions. Okay, so following the rules has worked out best for me in the radioactive trading positions. All right, I'm going to drink real quick here. Let's see, I'm going to scroll through some of these other questions. Okay, with it being 5/19, I see that I'm not going to be able to answer the next question. I'm going to go through Kent's first question that he sent in early, and this will probably help Nanek a little bit better. The question Nanek asks is, show me how to best use your tools. Well, here's what I want you to do. Later on, after this presentation, go to Power Options, go to Home, and go to Learning Center. And then I want you to go to Webinars. Inside the webinars, there are several archives here that will help you with the different tools. So the Power Options tools, depending on whether you're looking at covered calls, bull put, credit spreads. This one here, Introduction to Power Options, that'll give you a complete walkthrough of the site. And what I mean by that is probably what you need to know to use the site, the way that I use it to trade my own personal account. Okay. Now, if you're more focused on long calls and long puts or bull put spreads, you could go to one of these more pointed down or more linked positions. I'm sorry, I don't want to say that's more characteristic or strategy related introduction to Power Options presentations. But this is the best way. Okay, I need almost an hour and a half to show you the best way to use the tools, honestly. But this one here is probably about only 50 minutes to an hour presentation, and it gives you a complete walkthrough of how I use these tools to trade my personal account. And to answer that question, Kent's question from earlier was, suggestions for establishing a daily trading investing routine using Power Options. Let me show you exactly what I did this morning, which is essentially basically my exact routine of using Power Options every day. Well, I'll come in and I'll answer some of the emails in the morning, make a cup of coffee, do some other things, look at talk with the programmers about some of the strategy tools and some of the other things we're working on. But at around 9:30, 9:35, I'm going to log on to my account. And the first thing I look at when I log on to Power Options is right here. This is the webinar account, it's not my actual account, but this is the same process. I essentially have these data pods here set up pretty much the same way on my personal account. Market sentiment tool, market activity pod, top stock gainers, usually I look at, sometimes I don't, the power watch list, and on my personal account I also have, let's see here, new 52-week highs I usually have on there. Oh, and the ETF gainers and losers. I usually have that on there too. It's kind of same thing as what we're going to look at in a minute. First thing my eyes are drawn to at about 9:30, 9:35 in the morning is this pod here, market activity. What are the indexes doing? What's the SPX doing? What's the NDX doing? What is the VIX doing? Okay. Over here, I've got my watch list, and as you can see, they're very similar stock symbols to what we saw in the portfolio and some of the positions we were talking about today. CAR, Avis Group, Activision, Eris, Manitowoc, PWR, SWKS. These are the exact positions that are in my portfolio. My actual one is a little bit bigger. I've got more stocks in there. Okay. So what I'm looking at here is what are my stocks changed in the first 5 minutes of trading, and what are the indexes doing as well? This is the first thing I look at. Now the market sentiment tool I'll look at also, but I know that when I leave the day before. That's usually updated around 5:30, so I look at that just to know if we're in a neutral, bullish, or bearish sentiment. Let me address that real quick. The market sentiment tool is a collection of 13 broad-based indicators. We've set fences on those indicators over a 5 to 6 year period. Things such as put-call volume ratio, SPX number of days up, stocks over the SMA 20, and so forth. So when we have, going back in time, we could set the fences for each one. We can also see, well, if we hit a trigger where there's 4 that are bearish, 9 that are neutral, and 0 that are bullish, that's usually an indication of a market pullback. Okay, so if I see that the night before or when I first come in the morning, if I have positions, let's say married put positions that have moved up, and this kind of answers David questions, but not really. We'll try to get to David's a little bit more in a minute. The stock has moved up, and it's at my put strike price or a little bit higher, and I see that we're in a slightly bearish or a light bearish mode, for example. Last time we had that was 821. Okay, and it did pull back a little bit for a few days, but then it shot back up. But usually when you see this the sell warning there, it's usually it's moved up, so you can get a little bit pop back down. So what did I look to do here? Well, when I saw the sell warning, when I had stocks that were close to put, that's when I sold a call. I mean, think about it, a covered call or selling a call against a position, that's a bearish strategy. So I've got stocks that have gained. I want to get some of that in there. I took to sell calls here. On positions, bear call credit spreads, for example, I see the sell warning or bull put credit spreads. I may be tempted to roll that position or naked puts there so that I can look at those already. Rick, no, we're probably, at the rate this is going, we might be here till 6 o'clock. But Rick, I'm sorry, I haven't even touched the calendar spread questions yet. That's going to take me 10, 15 minutes to go through, so I haven't even gotten to that. So I'm just trying to go through all the questions, but let's go back to where we were before we branch off here. All right, so we've got this position here now. We've talked about, I log on, so I look at the market sentiment, look at the power watch, and look at the market activity. My next step, even though I've seen the power watch, what my stocks are doing, I'm going to go to portfolio, and we're going to go to profit and loss portfolio. Okay, so I've looked at what the market's doing. Now I got to look at what my positions are doing. As we saw before, if I've got a position where an alert's been triggered, I'm going to decide to take action. Okay, well, URI, or UA in this case, Under Armour's up. It's moved up above my trigger. This is a paper trade. Sorry, I wish I was in this one for our Fusion subscribers. I didn't do it. Or I wish I was in United Rentals when I was looking at it back in January, but we didn't. In any case, so an alert's been triggered. I may want to take action. All right, so what I'll do is I'll go to the Position Actions menu and Position Analysis. The position analysis, as I'm tracking the positions in the portfolio, is going to give me a breakdown of my current position. So I'm going to be able to see where it stands right now. What is my current liquidation versus my future expiration? By the way, this will show up for any position, whether you're in a bull put credit spread, bear call credit spread, Iron Condor. Okay, so we've got this here. See where my position is. Liquidation value is 10.1%. Future expiration, if I hold it all the way to expiration, make no adjustments, I'm going to gain a 7%. And here are potential income methods. Okay, so we see opportunities following the rules in the blueprint, or if I was just in a covered call, it'll show me rollout opportunities if the stock was above my short call, and things of that nature. So now I see these, and I want to sort of analyze, I'll show you guys where there's another archive webinar to extrapolate more on this. But I see my current liquidation is 10% right now, and if I roll out to, let's say, the September 20th call, which is 15 days away, my new percent if assigned might be 12.3%, the max return. Well, that's within my goals. I got to make sure that's within my goals. If this first adjustment that was shown only had a new percent if assigned or max return of 10.8%, well, that might not be within my trading plan, right? Even though it's 15 days away, I might be looking to make 1 to 2%. Let's say my trading goal is 2% per month. Well, if this is only a 0.7 increase for 15 days, that's not getting to my average. You don't want to roll for the sake of rolling. There's a webinar in there. on that webinars page under option strategies for rolling for the sake of rolling, and you don't want to just roll. Make sure the roll matches your trading plan. But I'm going to look at these adjustments, and I'm going to decide which one best suits my needs, and when I decide which one I may be interested in, I'm going to go to Simulate Trade just to get a better view of this particular adjustment, where I compare the positions side by side, see the new max return, the original max risk compared to the new max risk, my current return versus a potential maximum return. Okay, and the only way to see the side-by-side comparison and position analysis is if you're tracking your positions in the portfolio. All right, so I've gone through. I logged on. Whoops, sorry, folks. Let me go back to the main homepage. We took a look quickly at just our basic data points, looked at my watch list, saw what my stocks were doing, went to the portfolio, went to see if any alerts were triggered. I could also go to the alert summary to see if I have multiple portfolios, what's there. I'll take care of my positions first. Okay, positions that I feel need to be managed or might need to be managed. A lot of days there's nothing that I want to do. Okay, I'm going to let them get closer to expiration, get that time value working in my favor. Now what? Well, okay, let's go back to profit and loss portfolios. Oh, sorry, folks. Let's go back there. Let's close those down. Okay. All right, so back in the portfolio, depending on my current conditions, what do I have available? Okay, do I have capital available? Am I looking to open new trades? Let's say I am. Okay. Now, remember, I've got my portfolio set up the way I want to. I've got 50 to 60% of my capital in one strategy, 20% in another, 10 to 15% in another. So depending on, where my percentages are, when looking at them on the side, where my percentages are and what I'm looking to accomplish, am I looking for more income strategies today, or I'm looking for more long-term protective strategies? Well, we've got $14,000 to play with. Let's say I wanted to do a calendar call. All right, so I'm going to go into calendar call now. I'm going to go into search based on what I saw for the market activity, what I know from the market's been doing, and I'll run a search in my strategy. And then I'll tweak the criteria based on what I'd want to see for a particular strategy one way or the other. Whether I'm being more bullish, more bearish, looking for higher income. Most of the time I already have all my searches saved in a given strategy on my personal account for what I look for in certain things. So I'm going to run my search and look for new positions. And, of course, as I'm looking at positions, when I find one or put in my criteria, I'm now going to use that more information button, further research the stock chart, company information, news, and profile. And then if I've decided that this is the trade I'm going to enter, I'll go ahead and place it with my broker or use the broker link here. Depending which account I'm putting it in, I can use the broker link that goes to Options Express. And then I'll come back to Power Options and make sure I add it to the portfolio, so I'll start tracking it that way as well. At any given day, that's what I do from 9:30 to about 10 o'clock in the morning, while still answering emails, phone calls, and anything that comes in. My coaching session schedule usually starts at 10 in the morning, so I try to get all of that done beforehand. Is it possible, as you say, how can you manage all of your trades in a 20 to 30-minute period? It's because the Power Options tools, I've already set my alerts for when I'd want to make an adjustment. I've used the position analysis tool because it does all the math for me and shows me which will be my new return, my new max risk, my new max return, and my new probability if I adjusted the position. So I'm able to do that quickly, see which one might be the best one. Of course, there's always the other adjustment that works out the best, what we joke about being the 12th income method in radioactive trading. The blueprint teaches 11. Kurt and I always joke, or I always joke, that the 12th income method is do nothing. There's a lot of times when half of these positions I wouldn't be doing anything with today. Okay, so adjust my existing positions. Then, of course, if I have the time before a coaching session comes up or phone calls have come in, then I'll say, okay, you know what? I think just by the way the market's been, it's still kind of bullish, but I'm hesitant about it. I'm not sure if we're in a stance for long-term growth. Maybe instead of opening a new married put today, I'm going to open a standard collar. All right, just a 30 to 20-day trade. I'm going to look to make 3% if I get a sign, keep my risk down to 3.5% as well. Okay, so it does depend on market conditions for me. And maybe, if I just closed a spread, let's say I had one of those bull puts or iron condors on a broad-based index or ETF, and I made 80% of what I expected to make. I had made $1 originally when I opened the Iron Condor. I can close it today for only 20 cents. Well, I may just take that off the table, take the 80% of what I expected to make, and now I might open a new Condor or leg into it by opening a bull put or a bear call spread and then waiting for the market conditions to change to see what I could do then. Okay? And that's it. I mean, that is really how I use the tools at any given time. That's the basic breakdown of how I use these tools. Now, there's a lot more that's involved, of course, I didn't get to with searching because we're short in time frame. We're already at 5:30. Like I said, we're probably going to stay until 6 o'clock. However, later on for Nenek and even Kent, you wanted to get more information about, how to use the tools or suggestions for daily trading investing routine using Power Options. That's my daily routine, to tell you the truth. Some days are more intense than others. Today I spent the last half hour of the day from 3:15 to about 3:45 watching that SWKS trade like a hawk and trying to get the best fill price for buying to close one of those short calls in that income method number 5 position. But again, go to the webinars page, go to Learning Center, click on webinars. This is actually a public page, powerup.com/webinars.asp. I'll send that to everyone again through the chat window, I mean. But the introduction to Power Options, Nanak, that's going to give you much more in-depth discussion on how I use these tools for my personal account, and of course similar presentations, but just focused on covered calls, bull puts, long calls, and so forth, if that's your strategy. All right, let me scroll down here. I'm going to start from the bottom and move up. Oh, Sammy, I missed that. Do you have canned searches just in case you don't know what to look for? Absolutely. In any strategy, let's go, for example, I don't know. Oh, let's go to covered call. In any strategy, if you go to the search, we do have default searches for you. But Sammy, I think the best approach for you, depending on what strategy you're doing, go into sample searches first. Ernie and I have created themed searches for you to use as a stepping stone. We're kind of explicit in what they are. For example, here in covered calls, the broker and advisor recommended. Well, it's covered call selections with a good broker recommendations. They have to be part of the S&P 5-star group, and they have to be in an uptrend. Oh, you want to do a dividend covered call? Okay, you can do dividends with out-of-the-money covered calls, and here's a preset search for dividends and in-the-money covered calls. 5-star stocks in an uptrend, stocks with a low price earnings ratio, and if you have a smaller account and you're doing covered calls, there's searches there for the 25 report, under $10 and under $15 with safety. Other strategies, we talked about Iron Condor, for example. In the sample searches, just 2 basic ones, Iron Condors for higher price securities and indexes and ETFs. For the married put positions that we've been talking about, you just want to go in the search and use the radioactive trading ones. But in any other strategy, if you're not sure what you're looking for, go to sample searches first. You'll see a few theme searches for you to use as a stepping stone to create your own personal search. Okay, David says, let me just get this. I'm going backwards now. I do have a radioactive position in URI, but I've taken losses on rolling the short calls. Should I stop selling calls? David, I'll tell you what, won't have time to this weekend. Why don't you send me an example, or why don't you send me some of the track record of your URI trade? Okay, you can send it to me just at support@powerup.com or support@radioactivetrading.com. There's good times to use income method number 1. I've been burned on Avis a couple times. I'll admit it freely. I'd have a much higher return if I'd never used income method number 1 on Avis. But at the same time, it's not so much that you need to stop selling the calls, it's that maybe we want to get a little bit more familiar with income method number 6. Maybe that would work better for us in some of these situations. Income method number 5 has worked well for me recently in the past 2 trades, but it's not good for every positions. Okay. All right. Rick has been very patient, so I'm going to try to first Nanak, and then I'll get to Rick's questions because he's been very patient with me. Nanak says, how can you find out how many call or puts sold on a given stock? Where we looked before. We used GPro as the example. Anytime you're on the chain or on a search, you can use the More Information button. Remember, we went to Research and then Stock Research. I'm going to go to GoPro, and I'm going to go to Quotes. Okay, so this takes us to the Stock Quotes page. Here is all the information that we have. The total call volume today was 28,248 contracts. Total put volume 17,000. Your total option volume today on GoPro was 45,000 contracts across the different months. Total open interest, 134,000 put contracts, 88,000 call contracts, and then your put-call open interest ratio and your put-call volume ratio as well. Okay, so that's where it is. It's best to find that in the research tool. All right, so you can access that by just putting in your stock symbol up at the top and clicking on Quotes. Okay, that'll take you to the detailed stock research page. But if I happen, let's say, for example, to be in the option chain or on the search, anytime you see the stock symbol, you've got the More Information button here. Next to the stock, just go to Stock Research, and that's where you can see that. All right, now I'm going to scroll backwards here. Okay, let's go here. All right. And David, yeah, I'll get to your question when we send me that email, and we'll talk about it. So the best time to sell the calls and the married puts as well. Okay, so let's go back in time. All right, good. I'm right where I want to be. First part of Rick's question. On a calendar time horizontal spread, where do you have a maximum gain and how would you experience maximum loss? Well, the maximum loss in any calendar spread, Rick, is the net debit. Okay, let's go ahead and pull up a basic calendar spread search. And I'm just going to take a random one and let's just look at the profit and loss chart and discuss it. Okay, so here's a calendar spread. I'm going to profit and loss chart on Red Hat. Red Hat currently at 6107. Don't like this one. 6107, that's way too weird. That was way too far out of the money. I should have adjusted the criteria, but let's go back. I'm going to use September again, 20 days out. I'm going to use the 65 call. That's going to look a little bit better. Fantastic. Here's a diagonal spread. With Red Hat at 6107, I'm going to buy the far out in time January 57.5 call for 1070, and we're going to sell the September 65 call for 85 cents. What is my maximum risk? 985. When does the maximum risk occur? When the stock drops to zero. That's your debit. Okay? So when would you experience the maximum loss? It's at 980. It's if the stock drops to zero, both calls expire worthless. That's when you lose the most. Okay? Is it realistic? No, but by definition we have to show it because that is the true maximum loss on a calendar spread. It is the debit, what you paid in the position. You paid 1070, you collected 85, you've got a net debit of 985, you could lose all of that. Keep in mind with the leverage of the calendar spreads, the stock could drop, let's say 5%, and drop $3 down to 58. I'm probably going to be losing close to 40% on my long call, right? So the stock drops down $3, we're going to lose maybe $2 to $3. Okay, so 30%. It's going to be about 30% on the long call, right, because of the leverage factor. But that full 985, when would we realize this? A, the stock drops to zero. Okay, so 1, stock drops to zero. That's when you'd incur that maximum loss. Stock at zero. 2, you hold the position after the September call expires. You hold the position all the way to January expiration. You make no other adjustments on the position. You sell no other calls against it, and the stock closes at 57. Well, your call expires worthless, so you lost 985. Okay, so at expiration, stock's anywhere below your long call price. Those are the 2 times you hit the maximum loss on your, whether it's a horizontal or whether it's a diagonal, right? Even if this was the same strike, if I bought the January 57.5, sold the September 57.5, we'd have a peaked profit and loss chart. The maximum risk that we'd have would be if the stock went to zero, or after this initial short call we did nothing else, and the stock was trading below 57.50 at January expiration. Okay, so follow-up. For instance, example, would buying a time spread on eBay at the 55 strike, hold on, 55, buy at 55, and selling a September 12 and buying the October regular expiration, there's an IV skew of 2%. Okay, well that's sort of, maybe I missed a question in there as well. Okay, all right, so, oh, and then I see the other question from Francisco in there, but hold on. Okay, so that's just the profit and loss. That's the max risk. The max gain is tricky as well. The max profit we see on this calendar spread at 310 occurs if the stock is trading right at $65 per share. The short call still expires worthless at September expiration, and we have over $7.50. We'd have $7.50 extrinsic value on our 57.5 call, and we'd still have several months of time value remaining. Okay, so that's the maximum return. But keep in mind, this is not etched in stone. It's a projection. Okay, this is the only thing we can do with calendar spreads. This is kind of why I like them, because it's sort of an arbitrary return. Well, not arbitrary, but it's best guess. Using what we have as options investors, the Black-Scholes pricing model, another pricing model, what we have to do is say, well, if the stock was at 65, we know our short call expires worthless. We don't have to pay anything to buy it back, so that's the max. We know that's the max return. But what this is taking into account is what is the theoretical value of our 57.5 January call if the stock was trading at 65 and our short call expired worthless. That's the max return. But it's a best guess using mathematical equations. So let's run that example. I'm going to put the stock at 65, go to 920, hit calculate. All right, so based on the Black-Scholes pricing model, we'd make the full 85 cents on our short call, of course, it still expires, and it's telling us that our long call would be worth $12.95 if the stock happened to be trading at 65 at September expiration. We paid $9.85 to get into the position. We could liquidate the January 57.5 call for $12.95. There's our $310 profit. However, this could be priced at $11.90. It could be priced at $11.20. It could be priced at $14. Okay, based on market conditions, shifts in implied volatility. This is the best guess that we can get using the Black-Scholes pricing model, using today's volatility, the market volatility, and the option implied volatility. Okay, this could be at a different price. You could hit 65 at September expiration and only be making $210 because the call is only worth $11.95. That's a possibility. But it's the best guess that we have with the information we have on hand. Okay, so that's for the calendar spreads. Now, you ask about this volatility skew of over 2. Let me take a look here. Search. I'm going to go to search by symbol for calendars. I don't know if I'm going to get the right one. Let's go into search by symbol. Let's use Rick's example on eBay. And I am buying in October, right? And I'm selling the September 12. All right, was it all weeklies? Let me just run this first, and let me go to more results here. Let's see what we get. Near month. Yeah, okay, so this, I'm sorry, September 12, and you want to do the 55s. There's 155. Am I getting the same strikes here? There it is. It's right there. Okay, let's go to the profit and loss chart on that one. 55, 55, horizontal spread. Debit of 112. When would you lose this? Well, this is a shorter term trade, so when would you lose this? Well, October expiration if you make no other adjustments and the stock is below 55. Okay? This is showing you the profit and loss chart at September, but at October, that's when you'd lose. Okay, and you'd mentioned, I'm sorry, the other part of this question is, would be buying a time spread on eBay at the 55 strike, selling September, buying October, there's an IV skew of over 2. I guess you're asking me, is that a good idea? Well, here's your profit and loss chart. Your risk is the debit of 112. Your max return is 93. Again, if and only if the stock happens to be trading right at 55 or around 55 at September expiration. You mentioned this. Let's go to the option research tool here. Let me go to the option chain here real quick. I'm just going to look at a small call chain for September and October. Let's see. So this is September 12th. I'll hold that. And now let's look at October standard as well. All right, so your 55, implied volatility on the 55 is 0.3085 for September, and it's 0.2588. So it's not really a 2-to-1 at all. You know, it's 0.30 to 0.2588, not really a 2-to-1 implied or 2% skew. So it's much higher in the near term and not as much further out. Okay, so that's good. That's you might want that setup. In fact, most people look for that because they want the higher implied volatility in the short term to get more of that decay in their favor and be paying for a lower implied volatility farther out. But let's take a look at something here. Stock research. That's interesting. So usually I'd expect to see this one reverse, and I'm not going to be surprised if that October option doesn't start increasing in implied volatility in the next 2 weeks. The next earnings confirmed is October 15th. Your standard expiration for October is the 17th, so that long call is greatly going to be affected by whatever these earnings are. So in the next week or two, I'd expect to see the implied volatility on that October call start to go up, as well as the put will start to go up as well. Because usually in these situations, what you see, the September would actually be a lower implied volatility, and the October would be higher, reverse of what you might want for a calendar spread, simply because the earnings event is going to affect one and not the other. All right. All right, so hopefully that covers the max loss and max gain, Rick, and also covers a few things about what we were talking about. Okay, David, you sent me an email. Fantastic. There we go. So if at expiry the stock is anywhere below 65, the call expires worthless. Yes. Going back, I don't think we can get there anymore. But yes, with the other example, if the stock was below 65, Rick, your short call expires. If it's below 57.5, you're going to have a big decline on your option premium. That first one we looked at on Red Hat where we paid $10, if the stock dropped below 57.5, that call is probably going to be worth $3 or so out to January. So we've lost 70% of what we invested in that long call. So yeah, it's great that the stock was below 65 and our short call expired worthless, but if it's too far below 65, we're at a 70%, 60% loss range on our calendar spread. No one wants to be there. Okay, and sorry, Francisco asked earlier, do you do adjust in your Iron Condor, and you plan the Condor in how many weeks? Well, for the spreads, Ernie's in the Optium trade folio at PowerOptions Applied, where Ernie picks trades, titanium's covered calls, Optium's as spread trades, which may be legged into an Iron Condor position. We've actually found that the sweet spot with most of these is going about 2 weeks out in time, 2 to 3 weeks out in time. The indexes and ETFs we use typically offer the continuous weekly series, whereas any given time you have about 5 expiration cycles in a row. We just saw that with eBay, where you had a September 6th expiration, September 13th expiration, the standard 20th September expiration, September 27th, October 3rd. Does that sound right? Yeah, October 3rd and October 10th, and the standard October 17th. So you've got multiple weeks out. The sweet spot is about 2 to 3 weeks out in time. Actually, I think it's more closer to 3 weeks out in time myself. The problem with doing week by week by week is depending on your account size, you're probably not getting as much premium as you want to see. Think about it this way. Sure, I might look to the standard September expiration, let's say it's 4 weeks out, and a bull put credit spread might give me 80 cents. I look at the weekly bull put credit spread, and I've got 4 weeks too, and it's offering me a net credit of let's say 30 cents. Let's be generous, 30 cents. Okay, so if I sell this bull put spread week by week by week, I should get $1.20 over those 4 weeks. Now let's just ignore for a minute that that's a major assumption that you're going to be able to get 30 cents for whichever spread you're looking at. But let's just assume that. It's okay. So you get $1.20, where if I just sold the natural one, you get 80. About a month ago, a gentleman on one of our open discussions who told us his account size, and he told us he was looking to invest 15 to 20% of his portfolio in bull put credit spreads, which dictate he was going to be doing 3 to 4 shares, 3 to 4 contracts, or under 5 contracts for each one, more than 2, under 5, somewhere in that range. And his commission fees were a little on the ridiculous side for a spread. It was close to $19. Okay, almost $20 for a spread. Okay, well, let's think about that. The first week, I sell a spread. I sell 4 contracts, and I get $1.20. And then I'm paying $20 for commission, so it's $1. And then hopefully it expires, and I sell the next one, and I get $1 for, remember, that's for 4 contracts, so we're doing 30 cents to give us $1.20, and then we got to take 20 off for the commissions, okay? So he gets $4 total if he does that for 4 weeks, assuming no other rolling and no other commissions. Now, he pays $20 for a spread. He does 4 contracts. He does the one at 90, and he gets, that example's not going to work, but in any case, he does the 80 at 4 contracts, so he takes in only $3.20, but he only pays one $20 commission. That one would still benefit with the weekly options. But you have to be trading 5 or 6 contracts. When we worked it out, the math that he showed on the spread that he did, he would have made more money selling the whole month out, 4 weeks out, including his commissions, than adding the commissions in week by week by week. So you got to make sure that you're doing multiple contracts of that. Now, in relation to that, do you adjust the Iron Condors? Yeah, you have to. I'm not going to take a loss. Well, I'm going to take a loss. Any spread trade, you're going to take losses. Any Iron Condors, you're going to take losses. It just happens. But the key is management. Okay, so what most investors do, and I don't do this with my other positions, my standard collars, my married put trades, but I do this with my spread positions. So we're in a bear call spread, for example, or a bull put spread, and the position moves against us. All right, meaning that here's my, let's take the Apple. Is that a 5-point? No, I'm not going to do a 2-point spread. Sorry, folks, I'm a little pretentious with that. I hate the $1-point spreads and the 2-point spreads. They just drive me a little nuts from time to time. I like a nice 2.5 or 5-point spread or 10-point spread. All right, so here's a position on LinkedIn. Selling the September 225 bull put and buying the 220. So I might enter the bull put first, depending on market conditions, or the bear call. And then if a situation presents itself later, I may enter the bear call. Okay, but let's look at our bull put here. So the stock moves against me. We collected an original premium, 164 minus 76, so we take in $88 premium. Okay. Now, the stock pulls back. It gets close to 225. Let's say it's trading right at around 225.50. And now my liquidation cost is going to cost me about, let's say, $3. I still got a week left to expiration. It's going to be $3 to buy to close the 225, and I could sell to close the 220 for maybe 50 cents. All right, so I'm going to close this out for $250 net debit. on my position. I keep the 88 cents, so really my loss here is going to be about $1.62 or something along those lines. Okay, so loss of 162. Now you say, okay, well we'll just roll to October. Well, and lower strikes. You know, I'm going to roll to lower strikes here in October. But what I really need to do to make a profit is probably make sure I'm getting $1.62. I doubt I'm going to get $1.62 for that October spread that's further out of the money. I'm probably going to be seeing 80 or 75 cents. So now I have to talk about, well, let's look at November. It's probably only 90 cents to $1.20. Now December, I'm probably rolling all the way out to January to get $1.60 or let's say $1.65. So I had to roll this spread because I've taken a loss of 162. Most investors try to look to roll for a credit further out in time, and that's good. But now I'm sitting on this margin requirement. I'm sitting on this spread for the next 4 months, just sitting there with a margin requirement in there just for 4 months to probably make 3 to 5 cents if it still expires worthless. I'm not normally a fan of that because I prefer to just go month by month by month. Right, so even if it was rolling for a loss, I still might just roll out to October because, okay, I can't get the $1.60, but what if I do get 70 cents here, and then 70 cents in November and 70 cents in December? But again, major assumption. But if that happens, now I'm at 210, and I'm well above what I could get for the January series, and I still got another month to go. So that's what you have to evaluate when doing those rolls. So yeah, you have to roll those positions if you want to stay ahead. Sometimes I will close for a small loss. Let's say that in this position at the day of expiration, the stock was trading right at 224.80, and it cost me 30 cents to close the call. Okay, well, I'm still profitable, 55 cents. I'm not going to roll to a new bull put spread. I'll take my gain. Let's say it's trading at 223, and I got to pay $2 to buy it back. Okay, well, depending on the number of contracts I put in, maybe I'm okay taking that $1.12 loss or so. All right, just taking the loss, and I'm going to look for a better position later on down the road. Okay, so that's kind of what I'd look for as far as rolling the positions. You most likely are going to roll your condors. A lot of them, hopefully for you, a fair amount of them will expire worthless. You might see 60 to 75% over time expire worthless. But remember, if you're setting up to that 9-to-1 risk-reward ratio, the one thing you can never afford to do, knock on wood, is take a full loss on one of those leveraged spread positions. You take a full loss, you've just wiped out 2 to 3 months of previous trades, as was verified by Rick earlier as well. You know, that's part of the problems. Okay, Francisco, you get your most loss. Let's go back to the Iron Condor position or bull put. Let's look at the Iron Condor now. Let me just pull up a basic Iron Condor. We'll take a look at the full position. Okay, so for a spread or for an Iron Condor, let's see here. Let's get into the search. All right. Well, this was testing for a customer who just want to see positions on Netflix, so that's why it shows up like that. Let's just go ahead and take the Netflix position. Okay. All right. All right, Rick. Thank you. Rick's got to take off. Thank you, and I hope we answered your questions as best I could for the calendar spreads. If you have follow-up questions, Rick, send me an email later on. All right. Here's an Iron Condor position. Okay, what is the max loss? The max loss is when the stock's trading below the lower strike put or the higher strike put. Okay, so we're selling a 425 put and buying a 415. That's your bull put credit spread on this side. Okay, you're selling the 425, you bought the 415. Now, if the stock drops below 415, okay, you're going to have to buy shares. You're going to be forced to buy shares of stock at 415, and then you can sell them at 425. You're going to have a 10-point loss, but you're going to keep this 90-cent net credit you originally received. Okay, so you keep that. So essentially, you've got a loss. That's your max loss of 910. It's when the stock drops below both strike prices, or on the opposite side, Francisco, goes above both strike prices. On this side, on the bear call, we sold a 540. I'm sorry, sold a 530. We bought a 540, so if it goes above 540, we've got a 10-point loss again. We keep the 90 cents. So there's our essentially 10-to-1 risk-reward ratio. We're risking 910 to make 90. Okay, so it's pretty much a 10-to-1 risk-reward ratio. That is on expiration, Francisco. Okay, that's expiration day. This blue profit and loss chart is expiration. It's curved red line showing you the profit and loss chart at the halfway point. So in Iron Condor, the maximum loss is usually realized at expiration if the stock is below your lower put strike price or above your higher call strike price. That being said, Netflix volatile, but we know, it bounces around a lot. For whatever reason, we don't know. Let's say Netflix collapses to $300 per share Monday morning. It just drops down to $300, loses $175 value. You're probably going to be at full loss. Okay, I mean, your put options now are so deep in the money that they're probably just going to be trading at intrinsic value. You've probably hit full loss. Okay, so if you see a large gap, 15, 20, 30% drop, 40% drop, and it drops all the way below your lower strike put or above your higher strike call, you'd probably be close to max loss even though you still have time left to expiration because they're just both going to go to intrinsic value. But that's be an extreme decline, an extreme situation in order for that to happen. Okay, but it can happen. That's the key to remember there. All right, well, I don't see any other questions come in. I think we've addressed them all as best as I could. I know that, the other previous questions that came in, I tried to give a good overview for Ken of what I do with my trading routine on Power Options. That's also mentioned on the webinars. More in-depth information for Nanek is in there in the webinars. And then the other question that came in, Leo asked it, and before the webinar was also asked by Eric, what trades can I make to make regular monthly income? After talking about a few of the strategies and that volatility comparison, what strategies work best in a low volatility or high volatility market. The thing for me, I think, to generate regular income but keep yourself protected is a standard collar positions. My married put portfolio, the radioactive trading portfolio, has outperformed my collar portfolio year after year over the last 5 years. It's because you leave the upside open and allow for more of those gains, and you're still only taking a 4 or 5% risk. But if you're really dead set on making premium on a monthly basis, trying to take in income on a monthly basis against a position, and you don't want to fall into the lie of leverage and you don't want to risk too much of your capital, the standard collar is probably going to be the way you want to go. All right. Sorry, as I'm saying that, I should transfer back over to the screen here. So yeah, that other question came in from Eric and kind of addressed Leo's question as well. What trades can I make monthly to generate a regular income or to make an income? Probably the standard collar is the best one because it keeps you out of the lie of leverage. You're still able to generate income. And you're going to be wrong sometimes, but when you're wrong, you're only going to lose 3% of what you invested in the position. Okay? All right. So I think that about wraps us up for today. If you do have any questions later on, go ahead and send me an email to support@powerop.com. Right here we're just showing the subscription prices. Our 20-minute delayed service for Power Options is $60 per month. We do offer the 20-minute delayed with historical tools. That's $100 per month. Our real-time service, every time you refresh the page and get the numbers at that instant, that's $100 per month. And the upgrade for the real-time plus the back-testing historical tools is $150 per month. Our upcoming webinar events, every Tuesday and Thursday at 12 noon, we host a radioactive trading presentation. Kurt's not going to be with us next week, so I'm going to be hosting those. Wednesday at 12 noon, we're going to host probably a strategy discussion for Power Options. We'll email everyone about that as well. And then next Friday at 4:30 p.m., are we? Okay, so we're not at standard expiration next week. Okay, we're still 1 week off. But still, next Friday at 4:30 p.m. Eastern Time, we'll have our open forum Q&A session. As we showed you before, you can view our archived webinars at any time. On Power Options, go into the Home tab, click Learning Center, and click Webinars. Or you can navigate directly by the link I sent you, powerop.com/webinars.asp as well. And as I mentioned, if you think of any questions later on, just go ahead and send me an email to support@powerop.com. You can also call us toll-free during market hours, or you can reach us at 302-992-7971. And those of you that are trial members and subscribers, of course, you can also schedule a coaching session at any time. Well, thank you, ladies and gentlemen, for joining me this afternoon. Thank you for all the great questions. We got a lot of good information out there, and hope to see you all again real soon. It's one of our upcoming presentations. Have a fantastic weekend, and happy trading. We'll see you soon. Good night.